Welcome back to Chapter 10 in your Cornerstones textbook. We're going to pick up with stock dividends. Now remember, dividends are an opportunity for a company to pay cash to its shareholders from its earnings. It is required to pay dividends for almost all classes of preferred stock, but it is not required for common stock. Now, most dividends are paid in cash, as I just said. However, a company can issue more shares of stock or other non-cash assets to its shareholders and call them dividends. Let's look at cash dividends first, and let's look at some of the language we use for dividends. We have different dates when we issue dividends. The first one is the declaration date, which is the date the dividend is announced. On that date, the company will say what dollar amount per share it will be paying in dividends and on what date it will pay them. On that moment, on the declaration date, the company incurs a liability. It now is going to debit its retained earnings. Remember, a dividend is a reduction in retained earnings, and in order to reduce a retained earnings account or an equity account, I need to debit that account. The other thing that happens on the declaration date is that the company will credit an account called dividends payable. Now, that word payable should immediately send a trigger off in your mind. That's a liability account, a short-term liability account. Another important date is the date of record. This is a date on which any person who is currently a stockholder will be eligible to receive the dividend. If that particular share of stock is transferred, the ownership is transferred after the date of record, the new owner will not receive the dividend. The old owner will receive the dividend. And this just helps because obviously there's going to be a little bit of a lag between the day a dividend is announced and the day that the checks actually get cut and in the mail and to their shareholders. And so the company usually announces on their declaration date, they also say shareholders as of X date will be eligible for the dividend, and that's what we call the date of records. There will be no actual journal entries on this date because it's actually really more of an important date for the shareholders than for the company's accounting records. The third date we care a lot about is the payment date. This is the date on which the dividend check is actually cut. The cash is actually spent. So when that happens, the company no longer has the liability to dividends payable because now it's actually fulfilling that liability. So it gets to clear that liability with a debit to dividends payable. And then obviously this costs them cash, so there'll be a credit to cash. Let's look at an example, Cornerstone 10.3 in your book. The Kingsmill Corporation has issued 3,000 shares of common stock, all of the same class. 2,800 shares are outstanding and 200 shares are held as treasury stock. On November 15th, 2011, Kingsmill Board of Directors declares a cash dividend of $2 per share payable on December 15th, 2011 to stockholders of record on December 1st, 2011. So first, let's prepare the journal entry at the date of declaration. What is the date of declaration? Well, it's the date that Kingsmill announces the dividend, and that date is November 15th. So we would put November 15 over here in our date area. Now, what are the account entries? Well, the moment they declare that dividend, they now need to reduce retained earnings. So you are going to make a debit entry to retained earnings for the full amount of the dividend. Well, what's the amount of the dividend? It's $2 per share. How many shares are outstanding? Right, 2,800 shares. Don't get confused by the 200 that are held in treasury stock. Remember, the company is holding those shares right now and they don't pay themselves a dividend. That would just be very circular. So they have 2,800 shares outstanding times the $2 per share that are actually payable. So that's a debit of $5,600. And then they haven't paid them in cash yet, right? So they have a short-term liability for themselves of $5,600, which we book as a credit to dividends payable. Now, what's the journal entry on the date of record? What's the date of record? Right, the date of record is December 1st, and that means that's the date before which or on which any shareholders are eligible now for the dividend that will be paid on December 15th. What entry does King's Mill make on December 1st? The date of record. If you feel like that's a trick question, then it sort of is, because there's no entry required on the date of record. This is a date that's important for the company and for the shareholders so they can determine who is eligible for the dividend, but there is no entry required. Lastly, what's the journal entry on the date of payment? So what's the date of payment? Well, this dividend is payable on December 15th. So the date on the entry for date of payment will be December 15th. What happens on that date? Well, the company no longer has the liability, the payable, for dividends, so it can clear the payable account with a debit to dividends payable, and then they're actually going to pay these dividends, which means they will have a credit to cash of the $5,600, and this is how they will record the payment of cash dividends. Now, we said there's another way to pay dividends, and that's with non-cash assets or with shares of additional stock. Stock dividends are opportunities for companies to give value to their shareholders without actually exchanging any cash. They give their shareholders additional shares, but there's no cash exchanged. This will increase the number of shares outstanding. However, there will be no change in any one shareholder's proportionate ownership share. Let me explain that with an example. We've got a company, and it has 2 million shares outstanding. There is a big shareholder, one somewhat wealthy person, who owns 100,000 shares of this company. 100,000 shares of the 2 million that are outstanding. That means that person owns 5% of the total shares of that company. The company decides that there will be a 10% stock dividend, meaning they are going to give 10% more shares to every shareholder. That means after this dividend, this particular shareholder will now own 10% more. So they had 100,000 shares, they'll now have 110,000. And every shareholder got 10% more, which means instead of having a total of 2 million shares outstanding, there will be 2.2 million shares outstanding. If you do the math, you notice that this shareholder still owns 5% of the total shares outstanding. This is what we mean to say when we say there will be no change in any one shareholder's proportionate ownership share. They still have the same proportion of the company. Now, what happens in a stock dividend? Well, we have two kinds, small ones and big ones. Small ones mean that the company is issuing less than 25% more shares. They will increase the number of outstanding shares by less than 25%. In this case, the way they record this, or the way they capitalize it, is to use the stock's market value, its market price, as of just before the dividend. Now, there are large stock dividends, and that's when a company will increase the number of outstanding shares by more than 25%, in which case it records the value of those additional shares at par value. Let's look at an example. We've got the Arlington Corporation. They have 6 million shares outstanding, and it's $10 par. Right now, the stock is currently trading at $12 a share. Now, when we say currently trading at $12 a share, what we're saying is that's the market value of that particular stock. So the market value is $12 a share. Determine how many new shares are issued and prepare the journal entry, assuming that Arlington declared and pays for a 5% stock dividend. Well, how many new shares will they be issuing if it is a 5% stock dividend? Well, the number of new shares that they will issue will have to be 5% times the number of shares that are currently outstanding. They currently have 6 million shares outstanding times 5%, which is written 0.05. That's going to be 300,000 shares. That's how many new shares they're going to issue. So after the stock dividend, there will be 6.3 million shares of Arlington Corp stock out there. What will the journal entry look like? Well, as of that date, Arlington Corporation is going to be decreasing retained earnings because it's a dividend. Remember, when a company issues a dividend, it's decreasing its own retained earnings by issuing those dividends, and it's going to do so to the tune of $3.6 million. Where did we get $3.6 million? Well, this is a small dividend, a small stock dividend, because it was for less than 25%. And we say that we record those, or we capitalize a small stock dividend based on the market value times the number of shares. If I take $12 times 300,000 shares, I get $3,600,000. So I'm going to decrease my retained earnings by $3.6 million, but I am also going to have 300,000 additional shares out there, right? Well, 300,000 additional shares is technically an increase in common stock. We increase the common stock account based on par value, right? So 300,000 shares times $10 par is going to be $3 million, and that still doesn't add up, right? What's the difference? It's a difference of $600,000. That's the difference. That's $2 per share difference. $2 a share times 300,000 shares is going to be my additional paid in capital common stock of $600,000. So I've increased my equity and decreased my equity at the exact same time. And this is how we did the math. Now, what if Arlington declares and pays a 30% stock dividend? Is this still considered a small stock dividend? No, it's not. It's now a large stock dividend, or a big one. And so we're going to take the exact same way of thinking about it. What's the number of new shares? Well, it's going to be however many shares were currently outstanding times another 30%, and that's going to give us 1.8 million shares, is how many new shares Arlington Corporation is going to issue as a stock dividend. How do we record that? Well, remember, any dividend is going to give us a reduction in retained earnings, and to reduce retained earnings, it's going to have to be a debit. When I have a large stock dividend, I take the number of shares. When I want to figure out what's the reduction in retained earnings, it's the number of shares times par value, not times the market value rather. It is times the par value. So 1.8 million shares times $10 a share is $18 million that I'm going to debit. And so then I am going to add value to my common stock account, which will be par times the number of shares, which is $18 million. In this case, my debits and credits add up, because remember, when I have a large stock dividend, I'm not going to be using the additional paid-in capital common stock account, because I will base my entry from retained earnings and for common stock both on the par value. And we'll look at that right here. In a large stock dividend, the change in common stock is based on par value, not based on the market value. So only small stock dividends should require an entry to additional paid-in capital. Large stock dividends will just be a debit entry to retained earnings and a credit entry to common stock. Now let's look at a stock split. It's like a stock dividend. It does increase the number of shares outstanding, and there will be no change in proportionate owner share. However, unlike a stock dividend, it decreases the per share par value, so there will be no change in the equity account balance. Let's look at an example. A corporation has 10,000 common shares outstanding with a par value of $30 a share. So there's 10,000 shares outstanding. The par value is $30 a share. There was a 2-for-1 stock split, which means every stockholder exchanges each one of their original shares for 2 new shares. So that means the number of shares will rise from 10,000 to 20,000. And the par value of each share will be reduced from $30 to $15 a share. So what was the total par value before the split? Well, it was the 10,000 shares outstanding times $30 a share, which got us $300,000. The total par value after the split was 20,000 shares times $15 a share, because it went down by half, so it was $300,000. Notice, par value before the split, after the split are precisely the same. Now, one last thing we have to think about in this chapter is the concept of preferred stock. Preferred stock is a hybrid between debt and common stock. It does pay a regular dividend. It's not an interest payment, but it is an obligatory dividend. Remember, common stock, a company is not obliged to pay the dividends. They can choose to if they want. Preferred stock, however, is like common stock in that it represents an ownership share in the company. Now, some differences. For dividends, like we just said, preferred stock usually requires the dividend payment, so it is more like debt in that way, except for when a company does not pay a preferred dividend, it's not the same as not paying your debts. It does not trigger a default. So it's not quite as bad. Companies don't go bankrupt for not paying their preferred stock dividends. However, they are still obliged to pay them. Okay, conversion. Some preferred stock can have a conversion characteristic, in which case the preferred stock may be converted into common stock at some predetermined price in the future. There's also the concept of liquidation preferences. And this is the line, if you will, that people stand in when a company goes bankrupt and it liquidates all its assets, meaning it tries to sell them all off. People who are owed debt by the company get to stand at the head of the line. The common stockholders stand at the end of the line and rarely get very much when a company is liquidated. Preferred stockholders stand behind the debt people, but in front of common stock. So you have a slight preference being a preferred stockholder when it comes to the liquidation of a company. There are a few other provisions that you can read about in the chapter, such as call provisions and the voting rights of preferred stockholders. Now, let's look at the dividend and other preferences for preferred stock. First of all, there is the current dividend preference. Preferred dividends must be paid before common stock dividends. There is no exception in general to that rule. A company cannot pay common stock dividends if it has not already paid its preferred stock dividends. Again, the company is more obligated to pay preferred stock dividends than anything else. There is also the cumulative dividend preference. Now, this goes along with the current dividend preference, and this is what it says. It says that preferred dividends, both the ones for the current year and any preferred dividends in arrears. In arrears means any ones that didn't get paid in a previous year because maybe the company didn't have enough cash or something. So all preferred dividends in arrears and current preferred dividends must be paid before a company can pay dividends to its common stock shareholders. The last preference actually deals with some kinds of preferred stock, not all of them, but some of them have a provision whereby preferred shareholders receive their minimum dividend and then sometimes an additional amount in excess of the stated dividend rate. But let's focus on the first two. Your example is on page 489, and it's about Jefferson Manufacturing. They have one class of common stock, one class of cumulative preferred stock. Remember the cumulative. On January 1st, Jefferson's preferred dividends were 1 year in arrears, and that amount per year should be $6,500. From 2011 to 2013, Jefferson's board of directors determined they would be able to pay $9,000 in dividends, $12,000 in dividends, and $15,000 in dividends, respectively. Meaning, in 2011, they'll have $9,000 available for dividends. In 2012, $12,000, and in 2013, $15,000 available for dividends. So, how are they going to split those up? Well, let's look at the years. 2011, 2012, 2013. We know there's going to be $9,000 available to pay dividends in this year, $12,000 in this year, $15,000 in this year. How much in dividends will they pay to their preferred shareholders at the end of 2011? Well, they at least have to pay $6,500, right? Because these are cumulative preferred, and preferred stock always comes with the current preference, meaning preferred shareholders must be paid in the current year before common shareholders can be paid. So at least they had to pay their 2011 preferred dividends at the end of 2011, right? But note, on January 1st, 2011, they were 1 year in arrears, meaning they owed 2010 dividends too. So they have to pay those also, which means they owe $13,000 in dividends to their preferred shareholders. But how much do they have available? Only $9,000. So looks like they can only pay $9,000 to their preferred shareholders in 2011. They definitely don't have anything left over to pay common yet. And in fact, when they start 2012, they still owe that remaining $4,000 from 2011 to their preferred shareholders, plus they owe that year's amount, so they owe $10,500. Do they have anything left in 2012 to pay their common shareholders? Well, yeah, they do, because they thought they were going to have $12,000, which means they have another $1,500 that they can give to their common stockholders. Now let's look at 2013. Do they have anything in arrears as of 2013 for their preferred stockholders? No, they don't. They got current, right? They got all caught up in 2012, which means they just owe the $6,500 for their normal annual preferred dividend amount for 2013. How much is left over? Well, $15,000 minus $6,500 is a full $8,500 left over for those common shareholders. They'll finally get something. And that concludes our videos for Chapter 10.